Is Prologis a good investment? Let's get started with the model. This is a large cap company, 116 billion market cap. They're trading at 123 a share, and they have 940 million shares outstanding. Prologis is a leader in logistics real estate with a focus on high barrier, high growth markets. They control 1.2 billion square feet of space with their properties and development projects across 19 countries. They lease modern logistics facilities to 6,700 customers. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Free cash flow looks pretty good. $3 billion in 2021, up to $4.1 billion in 2022, up to $5.4 billion in trailing 12 months. It does come down a little in trailing 12 months, but still $5.2 billion is a lot of free cash flow. Look at their margin, 67%. The reason they're so profitable is because they're a REIT. REITs are similar to management companies. They don't need that many employees either, just a few to manage their projects. Net income is the profit or loss on the income statement. It's revenue minus expenses. That's also pretty strong as well, around $3 billion a year. Margins 36%, which is amazing, but look at 2021, 62%. Revenue is the sales for the company, and that went up a lot from 4.8 billion to 8 billion. It did come down a little in trailing 12 months, still pretty strong numbers. They pay a nice dividend, 3.1%. They could almost cover it 1.5 times with their free cash flow. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows. Past year 4, that's 125 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $110 billion. We divide that by 940 million shares. And we get a calculated stock price of 116. They're trading at 123, so they're trading at a 6% premium. It's a sell according to the model. Do you think it's a buy or sell? Let me know in the comments. There are 16 companies in the same industry as PLD, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They spend the most in CapEx, 5.3 billion. REITs tend to pay a lot in CapEx when they acquire things. Usually they acquire real estate, but not all REITs acquire real estate. Some REITs buy mortgages. Industrial REITs buy industrial facilities and rent them out. Some REITs buy distribution centers. Another industrial REIT might buy warehouses. They have a good debt to equity ratio, 0.6. For every dollar of equity, they have 60 cents of debt. Their dividend is pretty close to the median average. Global self-storage is number 1 at 5.8%. REITs tend to pay good dividends. The reason you get a higher dividend is you avoid double taxation. So you might have to pay the higher tax rate on your dividends as opposed to long-term capital gains. They're by far the biggest company in this industry, about double Public Storage. A good price to book, that stock price of a book value per share, they're trading at 2 times book value. ILPT is number 1 at 0.5. PE close to the average. The best is IIPR. I did a video on them once. Trading at 22 times free cash flow, equal to the median. National Storage is number 1 at 3.1. Price to sales 15. One of the worst on this list. Industrial Logistics is number 1 in this category. They're a really small company, 300 million market cap. They're number 1 in revenue, 7.8 billion, and they have a good 5-year annual revenue growth rate, 21%, higher than the median average. IIPR is number 1 at 67%. If you put $10,000 into this company 10 years ago, you'd be really happy at $40,000 today. That's a 15% annual return, a 300% total return. At one point in 2021, your 10,000 would have been 50,000. So it has come down since the peak, but still doing really well. To summarize, I have them trading at a 6% premium, ranking 5 out of 10. They're about in the middle. Would I buy them 4 out of 10? Seems a little overvalued. Average ratio is 5 out of 10. Financials look really good, 7 out of 10. Free cash flow up 73% since 2021. Revenue up 63%. Let's go through their third quarter earnings results. Their FFO per share is $1.45, up 9%. You generally want to use FFO instead of EPS for a REIT. Funds from operations is net income plus depreciation and amortization minus the gain on sale of real estate. It's a non-GAAP item, so you won't find it on a lot of websites. You have to look into their financials to find it. Average occupancy, almost 96%. They have 50.8 million square feet of leased space. Retention, 76%. That's for their owned and managed properties. They spent $1.25 billion on acquisitions in the third quarter. The weighted average cap rate is 5.1%. Cap rate is a really common term for commercial real estate. It's the rate of return on a property. If you invest in commercial real estate, I'm sure you're familiar with cap rate. So the calculation is net income over property value. The higher the net income, the higher the cap rate. The lower the property value, the higher the cap rate. There are some setbacks with the cap rate, so you shouldn't use it as a sole measure when investing in a property. It doesn't take into account debt. It also doesn't take into account time value of money. If you were looking at multiple properties, you only want to use the cap rate if they're similar. It really wouldn't make sense if you're looking at two totally different properties. Here's a good sentence to convey what the cap rate is. It's the yield, your return, on a property over a 1 year time horizon, assuming you don't use debt, you pay all cash. Here's another good definition in one sentence. The cap rate is a property's intrinsic value and unlevered rate of return. Unlevered means no debt. So the calculation is net operating income, NOI, over current market value. Net operating income is revenue minus expenses. Revenue is usually rental income, and expenses is a lot of things. Maintaining the property, insurance. They define it right here. Net operating income is your rental income, the income generated by the property. You could make income other ways, but usually the bulk is rental income. And then you deduct all expenses incurred for managing the property. It includes upkeep of the facility, taxes. The bottom of the equation, the denominator, you want to use current market value, not what you paid for it. Some people do use purchase price, but I don't think that's a good way to calculate it. And they talk about the purchase price version right here. It's not popular for two reasons. It gives unrealistic results for old properties that were purchased at lower prices a long time ago. The cap rate tells you the amount of time it will take to recover what you invested in the property. So if you have a 10% cap rate, it will take 10 years to recover your investment. So what is a good cap rate? You can't really answer that question unless you have more information. A high cap rate indicates a high level of risk. A low cap rate indicates lower returns but low risk. It's the same thing with investing. You can take a risk and invest in a penny stock, and there's a small chance you'll 10 or 20x your investment. Or you can invest in a stable, high dividend paying stock. You probably won't even double your investment over the next year or two, but you'll make a stable return. You might hear people saying a good cap rate is 5 to 10%, but there's so many variables, it's a hard question to answer. So this company's weighted average cap rate is 5.1%. So this is how you think about a 5% cap rate. Say that investment gives you $100,000 of earnings per year. Then that indicates the property's worth $2 million, $100,000 over 5%. Let's take a look at their income statement. Here's the third quarter of 24. Revenue, $2 billion, last year $1.9 billion. Most of it is rental revenue. It went from 1.8 to 1.9 billion. Strategic capital, $135 million. And they have development management and other, $3.9 million. So development management is fees on the projects they develop. And these fees will get bigger and bigger as they develop more projects. The way it works is they buy a piece of land, then they construct a building, and then put tenants in the building and lease it out. But they can't really get fees until they start leasing out the property. This segment will grow more and more as they develop more properties. All the expenses tied to generating the $2 billion of revenue is $1.25 billion. The biggest expense is depreciation and amortization, then rental expense, or the maintenance. Rental is all the expenses tied to generating the $1.9 billion of rental income. That includes payroll, maintenance expenses. So operating income is up. It was $660 million, not $780 million. And they had a gain of almost $500 million on the sale of property. So their operating income is almost identical to their total expenses. That's just a coincidence. When you calculate funds from operations, you strip out the gain on the sale of real estate. Because when you really think about it, the gain on the sale of real estate should not be part of your profits. The purpose of this company is not to sell real estate, it's to rent it out. They have a lot of debt. They spend $230 million of interest on their debt. They do earn $85 million from investing in other companies. earnings from unconsolidated entities. If it's consolidated, then the financials of the consolidated investment is part of their financials. But when it's unconsolidated, it's just a line item on the income statement. Earnings before taxes, $1.1 billion. REITs don't spend much in taxes, $12.5 million. That's why you get the higher dividend. So net income, $1 billion. The way you calculate FFO, you start with your net income. Then you add depreciation and amortization, the $630 million, minus the gain on sale of real estate, $434 million. So you get your funds from operations of $1.3 billion. FFO is what's left over for you, the investor. And they give most of that FFO back to the investors in the form of a dividend. Let's look at their balance sheet. Total assets, $96 billion. The gross value of their properties is $92 billion. That includes $4 billion of land, $3 billion from their development portfolio. Most of the value is their operating properties, the properties they're currently leasing out to tenants. The value is $79 billion. They depreciated $12 billion, so the book value is $80 billion. Liabilities, $38 billion. They have $32 billion of debt and $6 billion of accounts payable. So they do have positive equity. Assets minus liabilities equals equity, $58 billion of equity. Let's look at a company on Simply Wall Street. It's trading at 113 billion market cap, down 4% in the past week, up 21% in the past year. Here's the stock price since 2011. It looks like it started out at $33, and that was in mid-2011. It fell to its all-time low a few months later, 25, but it grew a lot from 2011 to 2022, peaking at 168. That would have been a bad time to buy it. It hasn't even gotten close to that level ever again. It fell pretty sharply in April 2022, down to a little over 100. Pretty much trading sideways since then, up and down in a fairly tight range. Simply Wall Street's valuation is 174. They say the stock is 33% undervalued. 20 analysts priced this stock at 134. They say it's undervalued as well. Their revenue back in 2013 was $1.8 billion, and it pretty much had a steady growth since then, growing all the way to $8.5 billion. That was in the first quarter of 2024. It's down a little since then, down to $8.2 billion. Their debt back in 2013 was $9 billion, and it seems to grow each year at $32 billion. But that's what you have to do if you're a REIT. You have to take on debt because you don't have that much cash flow since you're giving it back to your investors. Because most of a REIT's cash flows goes back to the investors when they pay a dividend. As long as your equity is higher, as long as the properties you're buying don't go down in value, and their equity is always a good amount higher than their debt. Because if worse comes to worse, you could sell some properties to pay off some debt, but that's not what you want to do. Here's their yield since 2014. It peaked at 4% in 2015. It fell to 1.6% in 2021, not because they cut their dividend, because the stock price went up. When the stock price goes up, the yield goes down. The forecast for 2026 is 3.7%. The CEO's salary was $1 million. Now it's $1. He's so frugal. Total compensation, $51 million. He gets a lot of benefits, lots of stock options. Tenure as CEO, 12 years. Only a couple insider sells the past year, no buys. 94% of the company is owned by institutions, 5% by the general public. The biggest shareholder is Vanguard at 13%. Stitch Ting owns 2.3%. If there's ABP after the company name, it's usually Swedish or Dutch company. They happen to be Dutch. Capital Research, the LA firm, owns 1.8%. Morgan Stanley. If you see the letters AG after the company name, it's a German company. Union Asset Management. That doesn't sound too German, it sounds American to me. Their employee count went from 1,500 to 2,600, and the ticker trades on the pink sheets, New York Stock Exchange, Mexican Bolsa, Deutsche Börse, London Stock Exchange, the Bern, EuroTLX, Wiener Börse, and Sao Paulo Bolsa. So if you want to learn how to dig into financials and understand it as well as me, click on the video in the top right corner. Thanks for watching.